The American economy is teetering on a razor's edge. And when that fragile thread finally snaps, the devastation won't begin with mom and pop stores. It'll strike at the very heart of corporate America. The giants once celebrated as indestructible are now burdened with unsustainable debt, collapsing business models, and profit margins that have been sliced to the bone. We're talking about corporations sitting on $43 billion mountains of liabilities, share prices that have disintegrated from hundreds of dollars to mere cents, and entire industries dependent on consumer spending that's rapidly evaporating. When the crash lands, these so-called titans won't just stumble, they'll be the first to crumble. This isn't guesswork, it's the immutable law of financial gravity. Number 10, WeWork. Once hailed as the revolutionary future of office space, WeWork was valued at a staggering $47 billion in 2019. Today, it stands as a textbook case of corporate implosion. Even after multiple rounds of restructuring, the company remains suffocated under billions in debt, with a business model fatally exposed in an economic downturn. At its core, WeWork operates by leasing office spaces long-term at high fixed costs and subletting them short-term to startups and freelancers. During boom years, that model looked flexible, even visionary. But when the economy contracts, small businesses fold, freelancers vanish, and large companies cut costs, leaving WeWork responsible for massive lease obligations with no steady tenants. After filing for bankruptcy in 2023, the company scrambled to offload leases and slash expenses. Yet it remains shackled with over $10 billion in long-term commitments, a ticking time bomb on its balance sheet. If the economy tightens further in 2026, vacancy rates in co-working spaces could soar beyond 50%, draining revenue streams to dust. Investor confidence has already evaporated. WeWork stock, once trading at $400 a share before it split, collapsed to under $1 before being delisted entirely. That kind of freefall doesn't just reflect poor management, it exposes a business model that was never sustainable. The cultural and economic shift toward hybrid and remote work only deepens the wound. Corporate giants like Meta and Amazon are downsizing their office footprints, not expanding them. And if big firms no longer need space while smaller ones can't afford it, who's left to occupy WeWork's gleaming glass walls? Landlords are notoriously unforgiving. Defaults on leases could accumulate, lawsuits could mount, and cash burn could exceed $500 million annually during a downturn. In a contracting economy, WeWork's supposed flexibility won't save it, it'll destroy it. The very model that made WeWork famous will ultimately leave it with empty offices, unpaid bills, and no escape route. Number 9, Carnival Cruise Line. Carnival Cruise Line was once the glittering emblem of leisure travel, a floating empire of luxury, ocean sunsets, and endless buffets. But beneath that polished exterior lies a crushing burden of debt. By 2025, Carnival is drowning under $31 billion it borrowed to survive the pandemic shutdowns. Even with demand recovering, the company is suffocating under more than $1.5 billion in annual interest payments alone. In a healthy economy, Carnival can limp along. But in a downturn, this debt transforms into a financial noose. Cruises are a luxury, not a necessity. When families tighten their budgets, the $5,000 Caribbean vacation is the first to disappear. A mere 15 to 20% drop in bookings could turn Carnival's fragile cash flow into a disaster zone. Add in rising fuel prices, already consuming roughly 15% of total operating expenses, and the outlook darkens further. The company also faces fierce competition from Royal Caribbean and Norwegian Cruise Line, both investing heavily in state-of-the-art ships while Carnival struggles to maintain an aging fleet weighed down by escalating maintenance costs. The issue extends beyond ticket sales. Nearly 30% of Carnival's revenue comes from onboard spending, alcohol, excursions, spas, and luxury extras. But as inflation continues to choke household budgets, passengers are spending less. Who's splurging on cocktails at sea when groceries back home already strain the wallet? In a recession, the domino effect would be brutal. Bookings plummet, debt payments soar, and investor confidence collapses. Carnival could be forced into another restructuring or even bankruptcy protection. And unlike airlines, which are often rescued through government bailouts, cruise lines are seen as pure luxury. There's no too big to fail safety net here. Carnival's massive ships may still float, but financially, they're sailing directly toward an iceberg if the economy sinks. Number 8. Paramount Global. Paramount Global, parent company of CBS, Paramount Pictures, and its struggling streaming arm, Paramount Plus, is a fading media giant running on fumes. On paper, its $28 billion in assets may look impressive. But beneath the surface lies $15 billion in crushing debt and revenue streams that are rapidly deteriorating. The decline of traditional cable, once Paramount's financial lifeline, continues at a relentless pace, plunging 6 to 8% per year. While advertising income has been shrinking by over $1 billion annually as audiences migrate online. To counter this collapse, Paramount pivoted aggressively toward streaming. Yet Paramount Plus has turned into a financial black hole. Despite burning through nearly $6 billion annually in content costs, it still trails far behind giants like Netflix and Disney+. In an economic downturn, when consumers trim non-essential subscriptions, Paramount Plus could lose millions of users. Even a 10% subscriber loss could erase hundreds of millions in annual revenue. And it's not just streaming, Paramount Pictures' film division is equally vulnerable. Box office returns are notoriously recession-sensitive. A global downturn could slash ticket sales by 20 to 30%, leaving the studio bleeding from multi-million-dollar flops. Worse still, the streaming wars have left little margin for error. Paramount doesn't have Disney's deep pockets or Comcast's diversified empire to fall back on. Rising interest rates add to the chaos. Servicing its debt already costs close to $1 billion annually, and refinancing during a downturn would only amplify that burden. Credit downgrades are looming, and if investor confidence falters, Paramount's stock, already languishing far below its 2014 highs of $60 per share, could plunge even deeper. In essence, Paramount is fighting a three-front war: collapsing cable revenues, an unprofitable streaming platform, and unpredictable box office returns. If the economy collapses, this once mighty media empire could be forced into desperate fire sales, asset spin-offs, or even bankruptcy proceedings. Number 7. Delta Airlines. Delta Airlines has long been seen as one of America's strongest and most respected carriers. But even giants can't defy gravity when the economy nosedives. Air travel is directly tethered to consumer and business spending. When households cut vacations and corporations slash travel budgets, airlines are hit immediately and hard. During the 2020 pandemic, Delta lost a staggering $12.4 billion in a single year, a vulnerability that still lingers. As of 2025, Delta carries more than $20 billion in debt, much of it from aircraft financing and pandemic-era survival loans. Servicing this mountain costs the company over $1 billion annually. A serious economic downturn could reduce both leisure and corporate travel demand by 20 to 30%, erasing billions in revenue almost overnight. Unlike low-cost carriers, Delta depends heavily on premium travel, business-class seats that deliver much of its profit margin. If corporate travel budgets are cut, those high-margin seats stay empty, crushing profitability. Fuel volatility adds yet another layer of risk. Jet fuel represents nearly a quarter of Delta's total expenses, and with oil prices unpredictable, a spike during a downturn could inflict a double blow of rising costs and falling demand. Labor tensions are also escalating, with pilots and crew pushing for wage increases, further squeezing margins. Delta's international expansion, once seen as a growth engine, could backfire as recessions tend to hit global travel hardest. Routes to Europe and Asia could see passenger declines exceeding 30%, turning once profitable operations into financial sinkholes. Even Delta's frequent flyer programs, often treated as hidden gold mines, lose value if customers stop flying altogether. The numbers tell the story. Delta's market capitalization once peaked above $60 billion before 2020, but today it hovers around $25 billion, a stark reminder of fragility. Investors recognize the risk. In a deep recession, Delta could be forced into mass layoffs, aircraft retirements, or even partial government intervention. The airline's iconic slogan, "Keep climbing," might face its cruelest irony yet, because when the economy crashes, Delta could find itself grounded faster than anyone ever imagined. Number 6. Warner Bros. Discovery. When Warner Bros. Merged with Discovery in 2022, it was celebrated as the dawn of a new entertainment empire, a global content powerhouse poised to redefine media. But behind the glitz of red carpet premieres and blockbuster announcements lies a financial leviathan burdened by an immense $43 billion in debt, one of the heaviest in the industry. Servicing that debt alone consumes nearly $2 billion annually in interest, leaving the company with minimal room for strategic growth or innovation. Should the economy falter, that staggering weight of obligations could easily bury the conglomerate. The streaming battlefield is already ruthless. HBO Max, now rebranded simply as Max, boasts roughly 100 million subscribers, a far cry from Netflix's commanding 270 million. Despite pouring nearly $20 billion each year into content, Warner Bros. Discovery's revenue growth has failed to keep pace with its spending. In an economic downturn, streaming platforms are among the first luxuries households trim. A modest 10% subscriber decline could wipe out more than $1 billion in annual revenue. On the film side, Warner Bros. Has leaned heavily on tentpole franchises such as The Batman and Dune. But theatrical earnings are notoriously vulnerable to recessions. A global contraction could slash box office revenue by 20 to 30%, transforming billion-dollar productions into catastrophic losses. Advertising, the backbone of Discovery's traditional cable channels like HGTV and TLC, is already in decline, with ad sales plunging 14% in 2024. A recession would only accelerate that erosion. The company's controversial cost-cutting efforts have drawn criticism, including shelving completed projects like Batgirl for tax write-offs. While such moves temporarily reduce expenses, they also signal financial desperation. Investors have taken notice. Warner Bros. Discovery now faces a precarious balancing act between paying down debt, funding new content, and maintaining relevance in a cutthroat market. If the economy contracts, the entertainment giant that once promised to dominate Hollywood could instead become its most dramatic cautionary tale. Number 5. Rite Aid. Rite Aid should have been thriving in an era defined by aging populations and surging demand for pharmaceuticals. Instead, it stands on the brink of extinction. After filing for bankruptcy in 2023, the pharmacy chain remains crippled by over $3.3 billion in long-term debt and more than $1 billion in opioid-related legal liabilities. In the event of another economic downturn, these pressures could complete the company's collapse. Operating roughly 1,600 stores nationwide, Rite Aid has seen an accelerating wave of closures as foot traffic dwindles and competition intensifies. Unlike rivals CVS and Walgreens, which diversified into healthcare clinics, insurance partnerships, and in-store care centers, Rite Aid failed to evolve. Pharmacies were once seen as recession-resistant, but consumer habits have shifted dramatically. In a struggling economy, shoppers migrate to lower-cost alternatives like Walmart and Amazon Pharmacy, eroding Rite Aid's already razor-thin margins. The company's operational structure compounds the problem. Rising rent, wages, and supply chain expenses collide with shrinking prescription reimbursements from insurers. Rite Aid's gross margins hover around 22%, significantly below competitors, leaving virtually no buffer for error. On top of this, litigation continues to drain resources. More than 1,600 lawsuits tied to opioid distribution have kept cash flow perpetually under siege. The company's stock reflects its decline. Once valued at over $180 a share in the late 1990s, split-adjusted, Rite Aid now trades for mere pennies. That freefall underscores not only investor pessimism but also the market's realization that the brand lacks any viable long-term strategy. In a crash scenario, customers cutting back on non-essential items like beauty or convenience products could decimate Rite Aid's front-end sales, which account for nearly 30% of revenue. Without a robust healthcare arm to stabilize it, Rite Aid may have no choice but to liquidate or sell off its remaining assets. In short, Rite Aid isn't simply struggling, it's a dying brand that an economic collapse could erase entirely. Number 4. Boeing. Once the crown jewel of American manufacturing, a symbol of engineering brilliance and aerospace supremacy, Boeing today is a company staggering from one crisis to the next. With more than $52 billion in debt and persistent safety concerns, the aerospace titan is only one severe downturn away from catastrophe. The twin 737 MAX tragedies of 2018 and 2019 cost Boeing over $20 billion in settlements, grounding costs, and lost orders. Although production has resumed, the reputational scars remain. In early 2025, Boeing once again came under FAA scrutiny following safety lapses involving its 737 and 787 jets, resulting in fresh delays and cancellations. Airlines may tolerate inefficiencies in prosperous times, but in an economic crash, those same delays could prompt carriers to cancel or defer orders, choking Boeing's cash flow. Commercial aircraft, the company's lifeblood, account for roughly 60% of total revenue, and demand for planes is directly linked to global air travel. During recessions, airlines slash capital expenditures, grounding expansion plans. If passenger traffic falls by 20 to 30%, Boeing's $450 billion order backlog becomes largely meaningless as deliveries are deferred for years. Even its defense and space segments, comprising about 40% of revenue, are not immune. Governments grappling with fiscal pressures frequently postpone or scale back defense contracts. With U.S. deficits already soaring, Pentagon spending could tighten, cutting into Boeing's last dependable safety net. Meanwhile, production costs remain elevated due to lingering supply chain disruptions, and labor unrest continues to ripple through factories. Cash flow has already turned precarious. In 2024 alone, Boeing burned through nearly $3 billion in free cash. With annual debt servicing costs exceeding $2 billion, its financial cushion is vanishing fast. Once soaring above $440 per share in 2019, Boeing's stock now hovers near $170, a glaring signal of investor skepticism. If the economy collapses, Boeing faces a nightmare trifecta: plummeting aircraft orders, escalating costs, and limited government support. Unlike 2008, when airlines rebounded quickly, today's structural weaknesses, from manufacturing flaws to supply chain fragility, could leave Boeing grounded for good. Number 3. General Motors. General Motors once embodied the unmatched might of American industry, the very symbol of automotive dominance. Yet, history seems poised to repeat itself. Just as in 2009, when GM required a staggering $50 billion government bailout, the automaker now finds itself treading dangerously familiar ground. Today, GM shoulders over $110 billion in debt and liabilities, much of it stemming from pension obligations, supply chain pressures, and the massive capital drain of transitioning toward electric vehicles. The EV battlefield is unforgiving. Despite pledging $35 billion in EV investments by 2025, GM lags considerably behind pioneers like Tesla and Chinese powerhouses such as BYD. If the global economy falters, demand for pricey EVs, typically ranging from $45,000 to $60,000, could evaporate overnight. Consumers anxious about job security are unlikely to finance a new Cadillac Lyriq or Chevy Blazer EV when economic uncertainty looms. Labor expenses also cast a heavy shadow. Following the 2023 UAW strike, GM conceded to higher wages and enhanced benefits, commitments that translate into billions in additional long-term costs. In a recessionary climate, when auto sales plunge by 20 to 30%, these obligations morph into crippling financial anchors. Meanwhile, the costs of essential EV materials, lithium, cobalt, nickel, remain volatile, squeezing margins even tighter. Overseas operations provide little relief. China, GM's second-largest market, has witnessed dwindling sales amid intense competition from domestic EV makers. GM's stock, which once soared past $65 in 2021, now hovers around $30, reflecting investor anxiety. Should the U.S. economy contract sharply, GM could face collapsing sales, declining margins, and perhaps another plea for government aid. But unlike 2009, public and political appetite for another bailout may not exist. In an economic crash, GM's fiercest rival won't just be Tesla or BYD. It will be the haunting ghost of its own past collapse. Number 2, AMC Entertainment. Once the uncontested monarch of America's movie theaters, AMC Entertainment now stands more as a speculative meme stock sustained by fleeting hype than as a sustainable enterprise. The financial picture is grim. AMC carries nearly $9 billion in debt, and its annual interest payments exceed $500 million, an unsustainable burden in any economic downturn. Audience attendance, the lifeblood of theaters, never truly rebounded post-pandemic. In 2019, AMC sold approximately 350 million US tickets. By 2024, that figure had dropped below 250 million. The streaming revolution permanently reshaped consumer behavior, and in a recession, families trimming expenses won't splurge on $15 tickets and $10 popcorn when they can watch at home for a fraction of the cost. Even major blockbusters no longer guarantee safety. One box office failure can devastate an entire quarter's earnings. During a crash, studios often delay expensive releases, starving AMC of new content. Worse yet, concessions, which generate roughly 30% of total revenue and offer the highest profit margins, plummet when attendance falls. Desperate for reinvention, AMC has experimented with hosting esports tournaments, private events, and other gimmicks, but these ventures contribute little to profitability. Investors are well aware. The same stock that meme traders drove above $70 in 2021 now trades for under $5, the hype bubble long since deflated. If the economy collapses, AMC's reality will be merciless: fewer patrons, shrinking concession income, enormous debt, and no viable diversification strategy. Unlike streaming giants, AMC possesses no digital pivot. Unlike theme parks, it offers no alternate attractions. It remains a one-trick enterprise in an era when entertainment is accessible at home for the cost of a Netflix subscription. AMC's marquees may still glow at night, but in a severe economic downturn, those lights could fade for good. Number 1, Tesla. Tesla stands as the crown jewel of the EV revolution, innovative, visionary, and monumental in scale. Yet beneath that brilliance lies fragility. If the economy crashes, Tesla may prove to be one of the most exposed corporate giants of them all. At its peak in 2021, Tesla's valuation surpassed $1.2 trillion. Even in 2025, it remains an eye-watering $600 plus billion, a figure sustained largely by investor confidence, and confidence is the first casualty in a market crash. Tesla's fortunes rely heavily on robust consumer demand for premium-priced vehicles. Its best sellers, the Model Y and Model 3, average between $40,000 and $55,000. But in a downturn, consumers delay large purchases, especially those requiring financing. With average car payments nearing $742 per month and interest rates climbing, Tesla's vehicles become increasingly out of reach for the average buyer. A 20% decline in EV demand could erase billions in revenue almost instantly. Competition further tightens the noose. Chinese manufacturers like BYD and NIO are already outselling Tesla in China, the world's largest EV market. In the US, legacy automakers like Ford and GM are accelerating production. In a crash scenario, lower-cost alternatives will undercut Tesla's premium-focused strategy. Profit margins are also under siege. In 2022, Tesla enjoyed margins near 17%. By 2025, they slipped below 10%, as the company aggressively slashed prices to sustain demand. A prolonged global recession could push Tesla into its first unprofitable stretch in years. Moreover, Tesla holds over $5 billion in long-term debt and remains deeply intertwined with Elon Musk's personal brand. Investor sentiment is inseparable from Musk's image, and in a turbulent market, even a minor controversy could ignite a massive sell-off. Given its volatility, a 50% stock price collapse during a severe downturn would not be unthinkable. Tesla may indeed be the most innovative automaker of its generation, but it's also among the most overvalued, overexposed, and vulnerable. If the economy collapses, Tesla might not merely stumble, it could watch its empire unravel in real time.